Thank you very much for inviting me to give an opening remarks to this very important RegTech conference. I'll give you my perspective on the macroeconomics and the geopolitical risks ahead. And I will also share some of my thoughts on how the regulatory landscape might unfold going forward. We start with the macro. I think we can basically go to Clint Eastwood and talk about the good, the bad, and the ugly. The good, I think, is clearly the United States. A US economy has been much more resilient than we expected. We will see no recession in the near term, and the scenario of a stagflation actually has come down substantially in probability. So US will face 2% growth 2022 and most likely also 2023 and potentially also 2024. There is a number of reasons for this. Unemployment has remained low, below 4%. Real wages are again increasing, and with the low households indebtedness and mostly fixed mortgages, the households are in a pretty good position. What has surprised all of us is also the fact that US productivity has actually increased. Third quarter, we saw productivity above 2%. This is a major game changer because it implies that unit labor costs are now increasing around the levels which it's actually in line with price stability. Obviously, there is just a few numbers here on productivity, but if we would see US productivity improve at a steady pace going forward, that is a big game changer, given what we've gone through since the global financial recession when productivity has been very lackluster. There is one argument for why productivity can come up, and that's the fact that AI, it has its first impact on coders and programmers. They are normally tech savvy and normally early adapters. And so far, what we see on GitHub, we've gone from 5% of AI-generated code 12 months ago to actually close to 70% today. So that's a major improvement. If we then think about what could actually be seen as bad, unfortunately, a lot of that is related to Northern Europe. Germany is in a very difficult spot. After the Ukraine war, the gas supplies have come down. The energy-intensive industry in Germany, ranging from chemical to other sectors like automotives, but also heavy industry, is actually much below the pre-war levels. If you look at energy-intensive industry, they are now running at the 60-70% rate of the levels before the war. And that's a fairly big impact in a country that is actually the champion in a heavy industry. Another factor for Germany is the increased electric vehicle competition from China. BYD is now selling at a great price, a fair quality, and with very strong margins. So I think the Chinese electricity cars will really take a fairly large, substantial market share in Europe. And that has a big impact, particularly on German automotives, but also others. On top of that, we also have the China de-risking, and Germany has a bigger import and export share to China than any other country. So it's not only Germany, it's also the UK. If you would have asked for my advice, I would have advised against Brexit, but I would particularly have advised not to do it at the same time you have COVID and the war in Ukraine. If you look at the assessment, the impact on the capital stock is fairly large. If you compare it to trend level, it's actually some 15% below. At the same time, we've seen a fairly large labor supply shock, which implies that lower productivity and high wage costs are putting the UK in a fairly difficult spot, not only for the next 6 months, but for a prolonged period. On top of Germany, also in UK, also the Nordic countries are likely to face a lot of headwinds. Household indebtedness is high. Most of that debt is financed on floating notes, and this implies that it will take a long time for the household to adjust to a lower debt level, with actually the situation where the stock of debt is so much higher than the flows of income. I do think that the Nordics are more likely to recover. The krona is very weak. It gives us a very strong competitiveness. And we also have an advantage when it comes to AI and climate transition, given our high-tech societies. So what about the ugly? I don't think the ugly is really oil, because given that we've now seen that the oil price has actually been fairly controlled also after the war in Ukraine and also the conflict in the Middle East and the ongoing military operation, I think we have the oil fairly anchored in a range between 70 and 90 US dollars per barrel. And that actually puts us in a fairly good position going forward. As I see it, there are two major risk scenarios. The first is the risk of higher interest rates for long. For example, the US 10-year government bond above 5% for an extended time period. This would imply a substantial shift upwards from the real rate expectations that we've all had. Real interest rates have been closer to 1% on a longer term perspective, and most economists would argue that they are likely to go back to the 1% level once we're getting back to a more sustainable path. A 2% real interest would really change the economy. The risk here, I think, is very much focused on US fiscal policy. US is running a 6-7% deficit in a situation of full employment and peace. That will imply going forward that we're hitting 140% in debt ratio in the near term. The problem here is that the debt position and the fiscal situation is combined with increased political polarization. Regardless of your views on politics in the US, both presidential candidates are likely to be expansionary on fiscal policy, and the outlook for bipolar cooperation over the aisles is fairly low, and the appetite for fiscal restructuring is also very low. So there is a lot of bonds coming to auctions going forward in a situation where other countries are also running fairly high deficits. So clearly there is a risk here. My personal view is that interest rates are going back to below 4%, but it will take some time. But I do think that this low probability, high impact scenario is something that we really have to think seriously about. The other major political risk is clearly surrounding the environment for Taiwan. Any type of military operation or blockade against Taiwan would have really large global impacts. First and foremost, this is due to the fact that Taiwan is producing more than 90% of all advanced semiconductors. Taiwan Semiconductor Manufacturing Company are producing for NVIDIA, ARM, AMD, and almost all others that are putting up the architecture for the new AI society that we're moving towards. And I think we all can imagine that there is no sector that would be safe in such a situation. Obviously, all of our banks, all of our insurance companies, all of our automotive companies are running on rails of AI and advanced micro semiconductors that would be very, very difficult to replace in any type of short-term perspective. On top of this, China is very different from Russia. It is well integrated to global trade. Imports and exports are close to 40% of GDP, almost double the level what we see for Eurozone or US. So given that China is integrated into any type of supply chain, any type of sanctions that are close to similar to what we're now seeing on Russia will have a major impact on the global economy. And in addition to that, China is itself fairly vulnerable given the large exposure to export and imports in industry. This is a low probability event, but you also have to add that it has a very, very high impact. So there's the good, the US economy, there's the bad, Northern Europe, and then we have the ugly with the potential risk of high interest rates and a conflict surrounding Taiwan. This is a very complicated word, and you all have to prepare to navigate this very high degrees of uncertainty. If we're looking at the regulatory risk, I think it's very important to note that we've done very well. After Silicon Valley, Credit Suisse, Signature, and First Republic went under, the financial system has remained fairly stable. If we look at the banks, they've delivered very good quarterly reports both in Q2 and Q3. After the big global financial crisis, capital levels have gone up, risky activity has gone down, and we have today a much more solid foundation for the US, European, and global financial system. Having said that, in any type of situation where you get a financial shock towards our system, there is a risk that we get another round of prudential macroeconomic regulation. And I do think that there is a substantial overview going on both in the US and in Europe on this basis. So clearly, I think it's very important to participate in an open and good dialogue between regulators, banks, and other financial institutions. We want a safe and stable financial system while operating efficiently to distribute capital in our economies. But I also think there is a large opportunity when it comes to the regulatory sector in AI. We already have most of the data in digital data lakes. We also have the processing power already thanks to the cloud solutions that most people operate on today. If you look at the opportunities in AI, I think this is very close to the shift from bookkeeping to spreadsheets that we went through during the 80s and 90s. It will be much easier and less costly to produce a DD. Credit ratings are going to be better going forward, given that our system of reporting will improve. Our value creation plans when we invest will be easier to assess and present, given all the help that AI will give us. And the economic management of financial companies, but also all other companies, are very likely to improve over the next 1 to 5 years. So I do think that we have an opportunity where we can lower cost and also improve the stability of the financial system with the help of the new AI tools that are currently being developed and also employed broadly in the financial sector. I think the conclusion, to give you some kind of assessment from my side when you start your discussion, is that we live in a very complicated world. You need to be hopeful, but also fearful. The macroeconomic environment is improving, but it's clearly a very high degree of uncertainty and complexity in the world that we live in. When it comes to assessing the impact of new regulatory macroeconomic tools, I do think it's very important to really have a solid foundation in all financial cooperation. I do think when we're looking at the technology, there is an advantage of being a first mover. So I think everybody should clearly follow and closely follow the development in AI to see what we can do for our companies and our clients where we're trying to serve both our own interest and also society's interest. So thank you very much and good luck with your very important discussions the coming days. Thank you very much for listening.